Something quiet just appeared on a government website, and almost no one saw it, but it could decide whether you're allowed to buy silver next week. Buried in the CFTC announcements is one cold line about an emergency meeting on market integrity and precious metals set for a closed room at a fixed time. That same kind of safe, boring language was used in 1980, right before they flipped silver to sell only and wiped out anyone who was long. Now those words are back. The timing is strange, and the signals in the silver market are twisting in ways that do not look normal at all. If you own even 1 ounce of silver, or you're thinking about buying, you need to hear what this really means, because the next 72 hours may be the last window to move freely. Stay with me to the end of this video, because I'm going to break down the notice line by line, show you the 1980 playbook they may copy, and explain what smart money is doing right now. If you find value in this kind of deep dive, hit subscribe, tap like, and share this with someone who owns silver. It really does help this channel keep digging into what they want. Don't say in public. This is not fear porn, this is pattern analysis. And once you see the pattern, you cannot unsee it. Disclaimer, I am not a financial advisor. Before any ban is announced, markets usually whisper the news in their own language. Prices move in strange ways. Volumes jump where they should be quiet. Normal behavior breaks. In silver, those whispers are getting louder. The pattern looks less like healthy trading and more like a system bracing for doors to slam shut. It is the kind of nervous movement you see before authorities step in. The first clear signal sits in the spread between paper, silver, and real coins and bars. Spot prices on screens stayed soft, even on days when dealers were raising premiums and running low on stock. That gap is an irregularity. When cost and quote move in opposite directions, something is out of line. It is like a store cutting the official price tag, while customers are still paying more at the counter. Trading data shows another fracture. Liquidity in some silver futures contracts has thinned, even during active hours. Orders that once filled in seconds now struggle to match. The book looks hollow. This kind of hollowing out happened in bank stocks just before short-selling bans in 2008. Then too, the screen still showed prices, but fewer people were willing to stand in front of the risk. Options activity adds to the tension. Out-of-the-money calls, which bet on strong moves, have seen bursts of volume without clear news. At the same time, some large players appear to be quietly rolling or closing positions instead of pressing an advantage. If silver were simply weak, the pattern would be cleaner. Instead, it feels like a chessboard where powerful pieces are being pulled back from the center. The open question is why? If this were just fear of recession, the pressure would be spread across metals and commodities. But the strain looks focused. Retail demand is firm, dealer shelves are not full, yet the paper market presses down. That mismatch points toward one uncomfortable theory. Someone expects a rule change more than a price change. Seen through that lens, these signals form the early outline of a possible buying lockdown. Just as earlier crises showed, markets often move first, regulators speak later. The CFTC's sudden emergency meeting fits neatly into this pattern, like the final lock clicking on a door that has already started to close. The CFTC is the main referee for futures and options in the United States. It does not trade. It writes the rules of the game. When this referee calls an emergency meeting, traders listen, because rules can change overnight. Just as the earlier market signals hinted, the rule book now looks like it may be the next pressure point in silver. On paper, the notice for this meeting looks calm. The language is dry. Phrases like market integrity, position limits, and risk controls sound harmless. But this is the same style of wording regulators used before past crackdowns. Before the 2008 short-selling bans on bank stocks, notices also spoke only about orderly markets, not about blocking trades. The strong moves came later, behind closed doors. One clear red flag is the choice of a closed session. Normal CFTC meetings are public, streamed, and recorded. Here, only parts are open, and the silver discussion is moved to the private block. That shift is like a hospital pulling a patient behind a curtain. You know something serious is happening, even if you cannot see the tools. The timing is another irregular piece of the puzzle. The meeting lands right after a spike in silver demand and strange price action, not after a long study or public debate. In the past, calm, planned changes took months and many hearings. Fast, surprise meetings were linked to crisis moves, such as the rush margin increases in metals during 2011's price swings. What exactly is being planned remains unknown. Are they thinking about tighter position limits that mainly hit small buyers? Are they looking at new reporting rules that could scare brokers away from letting clients stack silver contracts? Or are they talking about temporary limits on buying dressed up as cooling measures? The vague words on the notice leave space for every one of these outcomes. That is the open question that keeps the tension alive. Like a city council announcing a meeting on traffic safety one day before closing a key bridge, the CFTC's careful language and sudden timing suggest more than they admit. Joined with the market fractures already in motion, this emergency move looks less like routine work and more like the quiet setup before a direct hit on silver access. Back in 1980, when the Hunt brothers were squeezed, the final rule changes also came after a wave of bland, technical language. The pattern is the same. Soft words on paper, hard limits in practice. Silver really lives in two different worlds. One is the paper world, futures contracts and ETF shares that promise exposure to silver. The other is the physical world, coins, bars, and industrial use. In theory, these two worlds should move together, like the left and right wheels of the same car. When they start to drift apart, it is a sign that something inside the system is bending. Paper silver is easy to trade. With a few clicks, a fund or trader can buy or sell the equivalent of tons of metal they will never touch. Futures and ETFs were built to make this process smooth and to keep prices in line with real supply. Physical silver is slower. It must be mined, refined, shipped, and stored. It cannot appear out of thin air. Lately, the gap between the screen and the shelf has been widening. Spot prices and some ETFs have shown weak or choppy action. At the same time, dealers have raised premiums on popular coins and bars, and some have posted out-of-stock signs for key products. This is an irregularity. It is like a theater showing empty seats on the booking app while people outside are still lining up and paying extra for tickets. Warehouse and delivery data add to the concern. On major exchanges, reported inventories move only slightly, even as futures volumes remain heavy. Yet there are reports of delays for large physical orders and shrinking available stock in some hubs. In past metal squeezes, such as during 2020's early pandemic panic, similar strains showed up when ETF share creation did not match the real flow of bars. Paper claims grew faster than actual supply. A red flag today is the sheer size of paper exposure compared to real, ready-to-deliver silver. Depending on the measure, there can be dozens of ounces promised on paper for every single ounce sitting in approved vaults. That structure works only as long as most people never ask for delivery. It is like a bank that works fine until too many people ask for cash at once. This brings the open question into focus. Is the CFTC's stability concern really about wild prices, or about a quiet fear that too many buyers might try to turn paper into metal at the same time? If so, a ban or limit on new silver buying would act like a lid on a boiling pot, holding pressure inside instead of fixing the heat source. Just as the earlier signals hinted, the fracture between paper and physical silver may be the real reason the emergency meeting is happening at all. When you look back at silver history, two moments stand out like crime scenes: 1980 and 2011. In both years, silver prices were rising fast, pressure was building, and then, almost overnight, the rules changed. The pattern from those shocks now looks disturbingly close to the signals we see today. In 1980, the Hunt brothers and others had built very large, long positions in silver. Prices had climbed from just a few dollars to almost 50. At first, regulators and exchanges watched, warned, and held public hearings. Then came the break. The COMEX and the regulators moved to liquidation only. Traders could sell, but they could not open new long positions. It was like allowing people to run out of a burning building but locking the front door so no one else could enter. The anomaly in that episode was how one-sided the move was. Officially, the goal was orderly markets. In practice, the change hit buyers far more than sellers. Shorts were given room to breathe. Longs were forced into the exit. Prices collapsed. The phrase Silver Thursday became a warning about what can happen when rules are rewritten mid-game. Fast forward to 2011. Silver had surged again, pushing toward the same $50 area. Instead of a single ban, the exchange used steep, rapid margin increases. They raised the amount of cash needed to hold silver futures 5 times in less than 2 weeks. Each jump drove out more leveraged buyers. The market broke lower. Public language spoke again of volatility control, but the timing of the hikes looked less like risk control and more like an emergency brake. The red flag across both events is the same. When silver moves too far, too fast, the response is not just to warn. It is to change the structure of the market in a way that mainly harms those on the long side, often including retail and smaller funds. That recurring pattern now haunts the current CFTC emergency meeting. The open question is simple but serious. If regulators felt driven to restrict silver buying in 1980 and to squeeze it through margin in 2011, what tool will they choose this time? Now that paper exposure is larger and public interest is wider? Like a detective seeing the same footprint at 3 different scenes, you have to ask whether this is still about order or about keeping silver in a controlled cage. And if the past is any guide, once the decision is made, it will arrive quickly, leaving almost no time for those on the outside to adjust. Follow the money, and the picture of a silver buying ban becomes clearer. There are always winners hiding behind the calm words stability and orderly trading. Now, the key question is who stands to gain if ordinary buyers are pushed away from silver, or if their access is sharply reduced for a time. The first group to examine is the large banks and trading houses with big, short positions in silver. Public reports, like the commitments of traders, have repeatedly shown that a small cluster of players carries huge paper bets against higher silver prices. When prices climb fast, these positions can bleed badly. A rule that slows or blocks fresh buying on the long side gives those shorts more time to cover, and to do it at lower prices. It is like a referee quietly giving one team extra timeouts when the game is turning against them. Another possible winner is any central bank or government arm that sees high silver prices as a threat to the story of low inflation and controlled risk. Precious metals often act as a public warning light. When they spike, voters start to ask harder questions about debt, money printing, and the real value of their savings. In the late 1970s, as gold and silver soared together, political pressure around inflation exploded and helped reshape whole elections. A cap on silver demand today could mute that signal, at least for a while. Industrial users can also benefit from a cooled silver price. Companies that need large amounts of silver for electronics, solar panels, or medical uses prefer stable, low input costs. If regulators choke off part of that investment demand, it quietly protects corporate margins. Their gain comes from someone else being told they cannot buy. There is also a quieter beneficiary, the exchanges and clearinghouses themselves. Wild, one-way moves, risk-breaking weaker members who cannot meet margin calls. If brokers or clearing firms fail, the exchange's reputation and even survival are at risk. Tighter rules on buying or sudden margin changes aimed mostly at longs can protect the core system at the expense of those on the edge. The anomaly in all of this is how little open talk there is about the conflict of interest. Regulators claim neutrality, yet many decision makers move later into private sector roles at the same institutions that profit from calmer, cheaper silver. It is like letting future employees design the rules for their own future bosses. The open question hangs over the current emergency meeting. Are these players now steering policy again, using market integrity as a cover story? Just as earlier patterns and past crackdowns suggest, the real goal may not be to protect you from risk, but to protect the system from you. The next 72 hours are not normal trading time, they are a pressure test. What the CFTC decides and how the market reacts could redraw the silver landscape for years. To see the risk clearly, it helps to think in simple pathways, the way an investigator draws arrows on a wall chart. If this rule appears, then this behavior follows, then these prices move. One pathway is a direct limit on new buying in futures by smaller traders. That move would not stop current positions from closing, but it would act like locking the entrance doors while leaving the exits open. In the first hours, prices might actually jump as news hits headlines and emotional buyers rush in through whatever channels remain. Then, as the rule bites and fresh fuel is cut off, the market could stall and break lower, giving large shorts room to cover into the weakness. A second pathway is sharp margin hikes that raise the cash needed to hold or open silver positions. This is the 2011 playbook. Within hours, leveraged traders would be forced to sell, not because they want to, but because they cannot post more collateral. Prices can gap violently in both directions as forced selling meets opportunistic buying. Liquidity thins, spreads widen, and the screen starts to look like a stormy radar map with big holes where normal quotes used to sit. A third pathway is a temporary halt or limit on creations in major silver ETFs. We saw a version of this in 2020 when some commodity funds suspended new share creation as markets went wild. If that happens in silver, the ETF price can break away from the value of the metal it is supposed to track. It is like a train that keeps moving while the tracks underneath start to bend. Arbitrage traders may profit, but regular investors are left guessing what they really own. The anomaly across these pathways is that, in each case, the stated goal is stability, yet the first effect is often more chaos, not less. Prices whip around, some doors slam while others stay open, and information becomes uneven. Just as in the GameStop restrictions of 2021, certain kinds of buying can be blocked while selling remains untouched. That uneven treatment feeds distrust and draws even more attention to the very asset officials say they want to calm. The open question, as the 72-hour window closes, is which path the CFTC will choose and how hard it will lean. Even a narrow rule can shock a fragile market, just as earlier crackdowns proved, leaving ordinary buyers to learn overnight what they are suddenly forbidden to do. If the CFTC goes ahead and blocks or limits silver buying, the real story starts the day after. Prices may move, headlines may fade, but the deeper change will be in how people see the system. When a market that was sold as free suddenly has locked doors, trust does not return easily. We have seen this kind of break before. In 1933, when the U.S. banned most private gold ownership, people shifted into numismatic coins, foreign gold, and other stores of value. In 1971, when the dollar was cut loose from gold, new offshore markets and futures contracts grew to fill the gap. Each time, the official channel was restricted, but the desire to protect savings did not disappear. It simply moved. Like water hitting a dam, it found every small crack and side path. After a silver ban or tight limit, something similar is likely. Some investors will move to physical silver only, using local coin shops, peer-to-peer sales, or trusted dealers, even at higher premiums. Others will try indirect routes, such as mining stocks or royalty companies, accepting more business risk in exchange for staying outside the direct line of CFTC rules. A few will look abroad, opening accounts on foreign exchanges, as happened after capital controls in countries like Greece pushed savers to seek options outside their own banks. The anomaly to watch is what happens if official silver prices calm down, yet physical premiums stay high and real bars remain hard to find. That would show that the ban has not really reduced demand, only pushed it into the shadows. Exchange volumes might fall, while social media trading groups and informal markets grow. It would be like seeing quiet streets on the surface while side alleys become crowded and loud. This leads to the next front in the quiet financial war. If silver is fenced in, will gold be next? Will rules spread to mining shares or even to other escape valves like foreign currency or some digital assets? The open question is, how far authorities are willing to go to keep tight control over where nervous savings can flow as debt piles up and real inflation fears return. Just as the earlier signals hinted, a ban would not be an isolated act. It would be another step in a longer pattern of turning access, not just price, into the main battleground. The scattered signals now line up like points on a map. First came the strange moves in silver's price and volume, the hollow liquidity, and the widening gap between paper quotes and real coins. Then the CFTC scheduled a closed emergency meeting using the same soft phrases that appeared before past crackdowns. When we lay those side by side with 1980's liquidation-only orders and 2011's margin shocks, the pattern stopped looking random. It began to look repeatable. At each stage in history, the official goal was order, yet the tools chosen hit one side of the market harder than the other. Buyers were boxed in, shorts were relieved, and trust was quietly drained away. Today's situation adds a new twist. Paper silver towers above physical supply, and digital access gives millions of small players the power to move together. That creates both a real risk of disorder and a strong temptation for those in charge to narrow the gates. The next 72 hours and the days that follow will show whether the CFTC chooses direct limits, stealthy margin hikes, EF changes, or a mix of all three. Even if no formal ban appears, the threat alone is a signal. Access itself is now under review. The red flags to watch are clear. Sudden rule changes, halted ETF creations, sharp shifts in margin, and any lasting break between futures prices and physical premiums. If these signs grow, it will confirm that something larger is underway, a slow tightening around the few assets that still sit outside easy political control. In that world, the real fight is no longer just over what silver is worth, but over who is allowed to touch it at all.